Happy Thursday, and more importantly, happy early Memorial weekend. Hopefully you have something exciting planned. If you're in the Pacific Northwest, you probably know the weather may not cooperate, but fingers crossed, weatherman's wrong. Anyways, we have some good stuff to cover this week. We've got the FOMC minutes that came out yesterday. We've got some terrible home sales data and a great, very timely question of the week, all about what the heck is a basis point anyway, which will tie in a lot to our conversation about the Fed. My name is Brandon Steele. I'm a financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday at 3 is to bring to you the market news, the data, the trends, all the good stuff we're watching, and hopefully weed out a bit of the noise along the way. So again, Memorial Weekend is coming up this weekend. Assuming it does not rain, I will hopefully be getting out golfing, but hopefully you're able to relax and celebrate, maybe do some barbecue or whatever you enjoy doing on a long weekend there. This week was really where the bulk of the data came in for this week's update. So on Tuesday, we had new home sales come out, and new home sales fell significantly to 591,000 versus expectations of near 750,000. My take on this is that a lot of what we're seeing here is due to not only the concerns with the markets, but also interest rates. Interest rates have spiked over the last few months. And what happens when interest rates spike is that a lot of those folks who are financing, number one, either get priced out, or number two, decide that, maybe it's not worth as much as it once was to finance that extra money over 30 years. So interest rates, I think, are having a big impact on that. We will continue to watch home sales and home pricing data in the coming months, but not a good number on Tuesday for new home sales. Wednesday, the Fed meeting minutes came out, the FOMC minutes, and the Fed basically is saying that they are planning for aggressive hikes now in hopes to allow flexibility later in the year, which I thought was very, very interesting. It's a little bit of humility, I think, that comes along with this that we maybe haven't seen looking backwards. We will see what they say, obviously, in the upcoming meeting, but they had kind of suggested in these minutes that they are going to raise rates by 50 basis points. Again, stay tuned for the question of the week on what the heck that means. 50 basis points for the next two meetings, in other words, June and July. And again, they're hoping to kind of get ahead of it because in the minutes, it seems like they had indicated some concerns around potential cracks in the financial markets, which of course, we're seeing, right? I mean, the markets have pulled back significantly since the start of the year. But what I want to maybe point out with all this Fed talk is to remember that even as they go down this path, even with these rate hikes, the Fed is still being accommodative. They are not being loose with monetary policy now, or tight, with monetary policy. They are tightening, but from a very, very loose stance. Okay. That's really, really important to note is that they are still accommodative, even with all these changes that are coming up based on how far they went to drop rates in the past. Okay. And buy assets, by the way, too. Okay. I think that's really important kind of caveat to tie in here. But the gist of it is that, again, they're suggesting 50 basis point hikes over the next two meetings, ideally to allow for flexibility later in the year, which, obviously, if there is any recession concerns, which I'll get to here in a minute, or anything along those lines, may allow them the ability to at least pull back on rates or, kind of unwind some of the increases that they've done. All right. We saw stocks rise significantly after this. Wednesday, markets ended pretty strong. And then today, Thursday, really great day in the markets. And I think it was due to a glimpse the Fed is not 100% set down one path. The last interview where we saw the markets just fall apart, the Fed almost basically said they're doing 50 basis points for the entire year, each meeting, and nothing will change that. Now they seem to be changing their tune a little bit, maybe a little bit of humility, and it's becoming clear, at least from the minutes anyways, that they will, after these hikes, watch the markets and watch the data to come and make decisions as that kind of transpires. Today, we had initial jobless claims at 210,000. We had a real GDP revision at minus 1.5%. This is a revision, so remember, this is data that's already been out. But remember, there were some issues with inventory this past quarter. And so kind of take that GDP number with a little bit of a grain of salt. What I want to touch on real quick before we get to our question of the week is this talk about recession. Like that is, it's everywhere now. And for whatever reason, it had not been until just the past like week or two. For those who follow us, you know that we've been watching very closely this concept of stagflation. And generally speaking, that can lead to recessionary pressures. The challenge is that to have stagflation, you have to have inflation and little to no growth. Right now, corporate earnings are still growing. So, you know, we don't feel yet that a recession is quite on the horizon. We certainly are watching it. It's something that we are watching very closely. It's something that we feel like has a possibility a little further down the road, but maybe we're reacting a little too quickly right now. Okay. So that's kind of our take on this recession conversation. And you know, again, in order to have stagflation, it's not just inflation we need to worry about. We have to have lower or no growth as well. And corporate profits are still really doing well based on the current earnings season. All right, coming up next week, we'll talk about inflation. We'll talk about spending and consumer confidence, which will be extremely important, right? We've seen the market's reaction lately. Consumer confidence, will that be up? Will it be down? We'll have to wait and see. Plus a little bit of a start to jobs week next week, a little teaser as we move into get some of the jobs data coming out towards the latter part of next week. Remember, markets are closed on Monday for Memorial Weekend. And with that, I will get into my question about what the heck is a basis point. It's everywhere now because the Fed is talking about raising rates, and a basis point is 1/100 of 1% is the easy definition. Challenge is in our industry, we get so used to these words and these terms and you know, this industry jargon that we kind of like spew this stuff off without even thinking about it. But it's important to define this because the Fed is talking about basis points, and we don't know what the heck a basis point is. It's pretty hard to follow. So again, a basis point is 1/100 of 1%. So to come back to the minutes on Wednesday, if the Fed raises interest rates by 50 basis points, that is 0.5%. Okay, 25 basis points would be 0.25%. All right, you get the idea. So again, 1/100 of 1%, and the easiest way for me to think about it anyway is if you look at 50 basis points, just move that decimal point 2 places over. 0.5%. That's a 0.5 basis point, or sorry, 50 basis points, 0.5%. All right, so I hope that is helpful because we really get wrapped up in our ways in this industry. And I figured rather than sitting here telling you about, you know, basis point hikes without defining it, maybe we would spend a few minutes just sharing what exactly that means. And hopefully that'll help you, especially as we continue to focus more and more on the Fed in the coming months. Thanks as always for joining us. Have a great Memorial Weekend. Enjoy let's cross our fingers and hope for sun. But regardless, enjoy the holiday weekend, and we will see you next Thursday at 3 o'clock.